All right, everybody. Welcome back to Strongman Personal Finance. I am Christopher Bell, certified public accountant, long-term boglehead investor, author of the book Stop Being a Broke Loser. I'm exploiting my fans by charging them $3 for the ebook, and hater of stupid stonks and YouTube personalities that promote garbage to their fans. Now today, we're going to talk about Tattooed Chef, one of the newest, hottest stocks that one of my favorite boys on YouTube, Jeremy LaFufu, is talking about. Now, Jeremy is a piece of crap. He's garbage, he's a loser, and he's exploiting you people because he likes to charge up to $20,000 to teach you how to read a freaking annual financial report, okay? You know who teaches that for free? I mean, you can give me money if you want. But you know who teaches that for free? Me. Because all you have to do is go type in Tattooed Chef 10K and you can pull up this company's annual financial reports. And it shows you a bunch of information that you can learn and grow your knowledge of about this company. Now, Tattooed Chef, let's see what they're all about, because Jeremy LaFufu is pumping it, so it must be 10,020 billion X stock. So Tattooed Chef is currently trading at $20.23. And let's see how long it's been trading. So this company went public on, looks like September 12th, 2018. This company was brought public via Special Purpose Acquisition Company, which is a SPAC. So basically, instead of going through like the traditional method of being listed, you have these holding companies that are created and investors put their money into them. And then these companies go ahead and buy a private firm and bring it public directly. Now, SPACs are highly risky because there's not as much due diligence and information. You basically just give people your freaking money, the manager of the SPAC, because he's a hot investor. He's hot. He knows what he's doing. And then he goes and buys, or she, it could be a woman too, they go and buy a company. Now, Tattooed Chef, since it was listed, is up 111%. Wow. So let's see what this company does. They're a plant-based food company that offers sourced plant-based food. Its products includes ready-to-cook bowls, zucchini spirals. Wow. Okay, so basically they sell a bunch of liberal, communist, plant-based frozen food that they, I guess they sell it to a couple vendors. Now, just looking at this right off the bat, if I was looking at this on Robinhood and I saw this price-to-earnings ratio here, I'd be like, wow, this is definitely a growth stock because it has a very high price to earnings ratio. When you see a stock that has a high PE ratio, that means people are paying a premium for the stock's trailing earnings because they believe that earnings are going to grow pretty rapidly into the future. It's not necessarily a bad thing if a brand new high growth company has a high PE ratio, but there's also a lot of risks because if the future expected earnings of the company don't actually pan out, you could be freaking hammered. Now, if we go look at the stock's volatility, I see some crazy volatility here, okay? Company was listed, it stayed flat, blah, 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 and then it spikes up, and then it shoots back down, and then it spikes up, and then it shoots back down. See? You see the trend, ladies and gentlemen? These stocks, these new growing companies are highly volatile. So you need to be careful where you put your freaking money, okay? Because you could get potentially screwed. Now, Jeremy, I paused to spit. Jeremy probably bought this company at a pretty decent price. Maybe. And so I'm sure he's made his money. So he doesn't care when you buy into this company because if you buy into the company, that actually helps him because it pumps up the stock price. But just because Jeremy bought it and made a good return doesn't mean you should just go YOLO your money into this company because you could be buying at a very bad time. You could be buying when the company's overpriced. It all depends on how much you pay for the company. That is ultimately what matters. You don't just buy a company because it sounds cool and pretty. And I don't know what the appeal is of Tattooed Chef, okay? Me personally, I'm not a fan of tattoos, all right? I think you could have like one or two tattoos, and that's okay. It's classy. But like, to be covered in tattoos, I don't know. I just don't like that. And if you don't like that, you can unsubscribe. But let's go ahead and look at the website of Tattooed Chef. So here's the website. And, you can kind of look and see what some of the things they offer, bunch of liberal garbage, plant-based food. Now, apparently they source all their stuff from Italy, which tells me that they probably have low margins. I'm imagining, because Italian food is probably a little bit expensive. It's European Union, and there's labor laws, and they have to ship it across the freaking ocean. Food could be expensive, which could help hurt the company's margins in the long run. That's my guess. I don't know if I'm correct or not, but usually when a company's sourcing food from like a cheap area, generally that's kind of a good thing, because that means you have higher margins, as long as the food's actually good and people buy it. All right. So they actually have a pretty nice website. They talk about their plant-based food. Like, if I ate this stuff, I would be freaking starving. Okay. Now, I'm one of those corn-fed boys. I like to eat lots of meat, and corn, and potatoes. And if I ate this stuff, I would be freaking starving. I'd pay whatever we have to pay for this crap. I would eat the whole thing, and I would be pissed off because I would still be hungry. So let's go look and see what the pricing is of some of these things. The cauliflower mac and cheese bowl. See how much this costs. $10. Woo! Contains no pasta. Okay. $10 for that. Organic. Okay, $8. I mean, the prices aren't super crazy, but I mean, I don't know. This wouldn't fill me up. Maybe I'm not the person they're trying to appeal to. So let's see if we can find a store. What is the closest store to me? Oh, they actually have them at Walmart, Target, Whole Foods, Costco. All right, so when I was reading the 10K, they basically are highly concentrated at a couple vendors. So I imagine that, Walmart, Target, Costco, these are their main suppliers. Now, one of the risks of investing in this company is that if one of these vendors decides to drop the food, maybe it's not selling well, or, maybe the food sucks or whatever, that could significantly knock this company back. Because if they have such a concentrated client base where they sell their food to just a few companies, there's a massive risk that if Walmart dumps them or anybody dumps them, there could be a freaking problem, okay? So you need to keep that in mind. All right, so let's go ahead and look at Morningstar. So Morningstar, I got a free subscription for my library, the Bocosin Public Library. You can come stalk me if you want to. And this is where I can kind of get a good idea of like where the company is right now on a financial perspective, from looking at the numbers. The numbers are what I love. I don't care about hype, okay? I don't care about these clowns on YouTube that pump all these random stocks because they sound good. I like the numbers. So looking at the numbers, okay? Operating margin, negative 13%. Free cash flow, negative 40 million. And they have some, decent return on assets, equity, and net margin. But you'll see in a second that those returns came from basically an accounting gain. As of yet, I believe on a actual accounting basis and on an operating cash flow basis, this company isn't even profitable yet, okay? They're still ramping up, so there's potential, but as of right now, they're not profitable. I would not personally invest in this company just because I don't like the food. The margins aren't crazy. It's very new and speculative. I don't like it, but if Jeremy likes it, maybe it'll be a billion X stock. Now we go down, and I want to look at this is like a summary of the income statement, the balance sheet, and the cash flow. It's really convenient on Morningstar. Now, one thing that jumped out to me, looking here in the bottom left, you can see the income statement. So you can see revenue growth, that's good. And then you can see net income for 2019, that's in the red or whatever, purple, whatever that color is, was pretty low. And then you see this massive explosion of net income in 2020. Now, if you're a brand new investor, you're probably like, oh my God, see how profitable they're becoming? They're amazing. You can't miss this company. I mean, that's almost a 15% profit, 50% profit margin. That's pretty good. But as you'll see, it's actually an accounting trick, or not a trick, but that massive net income right there was from, some kind of weird gain that even I didn't understand. But if you go to the cash flow statement, that tells you a different story. You want to look at both. So here we see operating cash flows in the blue. It looks like they had negative operating cash flow. I can't even tell. And they basically survived off financing because you see they got actual positive cash flow from financing. And then the next year, their operating cash flow went down even more. And you see this massive explosion here in the, what is that? I suck with colors. Orange. You see a massive explosion in financing. That tells me that they either issued a lot of stunks, which dilutes the current shareholders, or they went into debt. Either one. I don't know what they did, but we'll see. All right. So you want to at least look over a company briefly and see if it actually interests you. And yes, investing can be personal. Me personally, I don't like this freaking food, okay? I'm not a liberal communist that eats a bunch of soy and plant-based stuff. Now, if you kind of like that stuff and you want to see this company grow, okay, you can go invest in their stock. But you need to be aware that this company, on a cash basis, is not yet profitable, and they're probably diluting the current shareholders, which means your share of the company's future earnings will go down and down and down and down, depending on what happens. All right, so let's go and look at some of the other ratios. So on Morningstar, I actually have this cool thing where you can look at a ton of key ratios, which is why I highly recommend you sign up for Morningstar. You don't have to pay for it. Your local library probably provides it free. I don't pay for this. But you can kind of look and see, okay, what are their revenues, gross margins, operating income. It's all good. It's so much information. You can see their free cash flow, operating cash flow. So right here, because that chart was so crappy, I can see their operating cash flow in 2019 was negative, what is that, in millions? Negative 1 million. And then they had even a greater loss on the cash basis of 13 million. Now, they had positive net income on the accounting basis, but you got to look at both, ladies and gentlemen. That's why they're both important. Then we go ahead and look at operating cash flow growth year over year. There's nothing because they're still bleeding money. Free cash flow growth, nothing. They're still bleeding money. Free cash flow as a percentage of sales went down, so it's actually worse in 2020. And the trailing 12 months, it's even worse, okay? This company is bleeding freaking money, all right? It doesn't mean the company's going to die. Maybe it'll succeed. But right now, it's so early. It's just too hard to tell if this company will actually make it. So let's go and look at their quarterly reports. I believe this is their quarterly report. All right, that's the annual. And actually, here's one thing that really pissed me off about this company. So normally on a 10K, you get these things called links, and you can click on the link, and it takes you directly to where you want to go. Now, their quarterly report had some beautiful links. So I was able to go and look and say, okay, I want to see the balance sheet, the income statement, whatever. But on their main report, there were no links. So just because there were no links, I've decided to not invest in this company. So looking at the 3 months ended March 31st, 2021. Let's see, their gross profit was $6.7 million. So let's see what their margins are doing, at least for this quarter. 677 divided by 52,682. So it looks like their margins went down even more. Their gross margin, which is taking their revenue minus their cost of goods sold, has gotten worse. And I think I'm seeing a trend where their profitability, based on their food prices, is going down and down and down. Now, it's just a quarterly report, so maybe this will change, but that's not a good sign to me. All right, so let's look at the cash flow. Cash flows from operating, negative $17 million. Okay, they're still bleeding freaking money. They're not even profitable, both on an accounting basis and a cash basis. Holy crap. All right, let's look. Cash flows from financing activities, positive cash flow. If you see brackets, that's a cash outflow. That means there's money leaving the company. When you see positive numbers, that means there's money coming into the company. Now, what stands out to me is that we had this massive explosion in financing activities, which means they raised a lot of money. Now, most of that money came from proceeds from the exercise of warrants. So basically, that's going to be diluting the shareholders because that creates more common stocks. So just looking at this is freaking garbage, okay? In just 3 months, they burned $17.5 million. Wow. And they raised $73.5 million, and they diluted their current shareholders. I am so enthralled and entranced by this company. So let's go look at the actual financial statements. So what is it? Page 40 is the actual statements. You see what I'm talking about? Where's the links? Tattooed chef. How am I going to find stuff without links? This is garbage. I had to scroll through this for like 5 minutes to find anything. But in the 10K, the annual report, you want to look at the business model. You want to read about what they actually do. You want to look at the risk factors. You want to look at management's discussion and analysis. That's the management talking to you and kind of explaining their financial results. And you want to look at the financial statements, okay? And it's a lot more convenient when there's freaking links. So let's scroll down a little bit. See, I would be going directly to the information, but of course, it's garbage. Now let's look. Here's one thing that stuck out to me. Customer overview. Our products are available at leading club stores and other major retailers. Our products were available in approximately 4,300 retail outlets in the United States. Now, here's what kind of scared me a little bit about this company. For fiscal year 2020, our 3 largest customers accounted for approximately 88% of revenue. For fiscal year 2019, our 5 largest customers accounted for approximately 95%. Now, revenue from these customers is 35%, 29%, 11%, 10%, and 10% respectively. Now, think about it. If one of their larger customers, we'll just say the 11% customer, decided to cut them off, like, oh, your products suck, they're not selling, that is going to have a massive freaking impact on their financial results. Do you see the risk here, ladies and gentlemen? If one customer cancels, doesn't want them anymore, this company is going to get freaking hammered, okay? And they even say it here. Risk factors. We are subject to substantial customer concentration. If we fail to retain existing customers, derive revenue, blah, 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 our business could be adversely affected. Yes, it could. And on top of that, you lose a customer, your gross margins are going down, your cash flow from operations is negative, your cash flow from financing activities is positive. That's just freaking garbage to me, okay? I don't care what Jeremy LaFufu said. I don't like this company. Our suppliers. We primarily source our vegetables from Italy. Ooh, yes. Which is one of the largest organic crop areas in the European Union. Now, like I said, Italy is it's not communistic, but it's very socialist. And I would imagine if you're buying stuff from the European Union, your food is probably going to be more expensive than if you bought it from, a developing Asian country. So that is kind of a turnoff to me. But if you're super into, plant-based food because you think it's the future, whatever, all right? So let's go look at the financial statements. And because there's no link, I had to look at it prior to this. Now, looking at their balance sheet, you want to check first the current ratio, which is their current assets, which are $206 million. And they have a lot of cash, which tells me they raised a lot of money, divided by their current liabilities. So their current ratio is actually pretty fantastic. It's probably like what? Let's do the math. I'm dumb. I can't do math without a calculator. Their current ratio is roughly 6.8. Okay, they're not going to go out of business anytime soon. Let's look at increases in long-term liabilities, which is debt, and common stock. Now, okay, so they're really not going into a lot of debt. So what that tells me is they're raising money, from stock issuances. And you can kind of tell right here because you go down to stockholders' equity and you can actually read how much stock they've issued. So on December 31st, 2020, they had 71 million shares issued and outstanding. And the prior year, they had 28 million shares. So that's almost a tripling of the number of shares outstanding, which massively dilutes the current shareholders, okay? Wow. I'm so enthralled. All right. And then you look at their statement of comprehensive income, which is their income statement on the accrual basis of accounting. Looking at here, 2019, they had positive net income in 2019. Interesting. And in 2020, they had a massive explosion in net income. Now, you may think, oh, it's because they're so amazing. But if you look right here, other income, what really helped them was $38 million of other income. Now, I was reading the notes, and it's had something to do with, they had a gain on some kind of, I don't even know what it was. It was actually super complex. But basically, they generated income, but not cash, on an accounting basis because one of their assets or whatever had a gain. That's basically it. So you want to really look into that stuff. All right, so that's a statement of income. Let's go look at the statement of cash flows to see the story from the cash basis of accounting. Yep, bleeding money. So they had a net outflow of $1 million in 2019 and $13 million in 2020. Wow, so profitable, so amazing. And of course, they had a ton of money raised from financing. Proceeds from reverse recapitalization transaction. Proceeds from exercising warrants. This all sounds like stock issuances to me, okay? This company's freaking garbage. This company is freaking disgusting garbage. Now, if this company does somehow succeed and it goes to the moon and I'm proven wrong, am I going to be mad? No, I'm not. Because I invest in total world stock market ETFs or index funds. I specifically have the VT ETF at 95% of my portfolio. So worst case, if I miss an explosion in a company, number one, I still probably own this company through VT. And number two, I don't care because I have a plan that I like and that I stick to, and I'm still going to do well in the long run. So you can't get all swept up in missing specific opportunities in the stock market because you're always going to miss an opportunity. Find me the person that actually knew Amazon was going to succeed, okay, when it freaking crashed during the dot-com bubble. A lot of people probably sold out of Amazon because it's so hard to actually pick a winning company. You don't really know. That's why it's all highly, highly speculative to pick individual stocks. Now, to close this out, if you want to put your money in this company, okay, I'm not going to tell you what to do. I don't like it. I don't like what they sell. I don't like the financials. I think there's a lot of risk because they're so concentrated with their suppliers. But if you want to put money in this company, keep it to a small percentage of your portfolio. The vast majority of your portfolio should be in index funds, in tax advantage accounts. And if you want to speculate and try to 20,000x like Jeremy does somehow, then you go right ahead, okay? But that's my thoughts on this company. I would say don't buy it. It's been targeted by Wall Street Bets, I believe, which is just another indicator that this is kind of a high-risk play. But, you do what you want to do, all right? Anyway, like, subscribe, tell your friends about me, buy my book, Stop Being a Broke Loser. Y'all have a wonderful, delicious day.